If rates are lower, though, does that lead to taking on more mortgage money, and ultimately does it fuel home prices? Let's get perspective from someone who covers that very closely. John Pasalis is the president of Realosophy and one of our regular commentators on the housing market. John, what was your reaction to the messaging from the new Bank of Canada governor?
You know, it was quite interesting. It was a very direct message. It did not speak to home buyers. I mean, people who are looking at buying a home for their family are not particularly motivated by, what's going on with the Bank of Canada's policies. I mean, this is a message clearly geared towards investors and probably predominantly condo investors, to really sort of lean on this segment of the market to kind of help drive our economy over the next few years. So it was really just kind of fueling sort of the optimism that we're seeing in pre-construction condo investment already, I would say.
Are you saying that, I mean, in the past we would talk about that outsized influence of the housing market in driving our economy. Are you saying in this very challenging time we're going to find ourselves relying even more heavily on housing because this low interest rate environment kind of encourages people into the market? It ultimately potentially fuels the prices for homes?
Yeah, that's what it sounds like. So the Bank of Canada is expecting business investments to be low. And most sectors are probably going to be lagging economically. And we think about the one sector that has done well. I mean, even during this pandemic, interestingly enough, it's the real estate sector. And it sounds like they're really kind of messaging to investors saying, listen, go buy some condos. The interest rate on your HELOC is going to stay rock bottom. Even when you take possession, rates are going to be rock bottom. And even if we see some turbulence down the road, we're going to have all these tools and instruments to kind of keep things stable. So it really, really does sound like that they're trying to lean on this segment of our economy to kind of help carry us through over the next few years. And certainly there is a risk, of course, when you're sort of fueling prices by sort of encouraging real estate investors that prices get disconnected from fundamentals, and I think that's kind of one of the downside risks of that messaging.
And I'll be clear, and I know the BNN Bloomberg junkies know this very well. Tiff Macklem just jumped into that seat. He was not part of any of the policy planning as we dealt with those initial innings of COVID-19. And so he's working with the deck that he's got at this stage of the game. But the point that he made, and we've heard this before, is that at the end of the day, one of the biggest drivers of what happens to the home market is if you have a job. And, between the months of March and April, we saw upwards of 3 million jobs lost in this country. What were you noticing in the housing market as people were losing jobs? We've started to see a little bit of a recovery on that front, but how would you connect those two storylines? How crucial is it being employed to ensuring that the housing market, does not come under some tremendous pressure?
I think it is certainly crucial. I mean, when we look at the unemployment numbers, it seems like there's a disconnect there. But there's a couple of big factors. I mean, number one is that the people who lost their jobs were disproportionately renters. That's one factor. We've had a lot of government support. We've had a lot of bank supports with mortgage deferrals. More than 50% of households are deferring their mortgages. So they're definitely still connected, but the big factor, of course, to keep in mind, and the Bank of Canada knows this, is that, household debt starts becoming a really, really big problem if house prices fall. And of course, unemployment is one of those factors, but it's really sort of the decline in house prices that causes all of these issues. And they're probably just doing whatever they can to maintain some stability in the housing market and in house prices to avoid some of these downward pressures that come with falling home prices.
So I want to go back to what you just said there. You've said disconnect a couple of times already in this conversation. Given that, and this is not just a Canada phenomenon, interest rates are low around the globe. And it's one of the reasons why we've continued to see this surge in certain assets, certain pockets of the stock market. We had Mike Novogratz, the billionaire investor, on recently, who outright said, we're seeing a bubble in some of the technology stocks. And traditionally speaking, when we're talking about bubbles, we're talking about a rapid escalation followed by a contraction. I mean, how would you characterize what's happening in Canada's housing market?
So the housing market right now is not characteristic of a bubble. When we think about bubbles, it's really, those are markets where purchases are disproportionately driven by investors. And we saw that in 2015 and 2016 in the GTA, when a lot of investors were buying low-rise homes in the outer suburbs of the Toronto area. And the market fell. Those were the areas that were hit the hardest. So that is not what's going on today. What's going on today is really not that different from a lot of other. We had this sort of shock to our market where buyers hit pause. The buyers that were in the market were not impacted by these declines. They're just working from home. They have jobs where they're able to work from homes. And not only are they all rushing back into the market at the same time, we're seeing this sort of new wave of buyers who probably weren't even looking pre-COVID, who suddenly want to move to the outer suburbs. And those areas, interestingly enough, if we look at the past 6 weeks, it's sort of these outer suburbs where sales growth is 30 to 40% above last year's volumes, whereas Toronto, I think, is still down slightly. So it's a couple of different dynamics that's really just fueling the market right now. But I'd say it's mainly this shock and surge in demand from end users rather than investors today.
Okay, so one of the headlines we had with last month's Greater Toronto Area housing stats was that we saw basically record pricing. And so I wonder what your outlook is, even if we're not seeing the traditional characteristics of the bubble, even if, it's really more of a reaction to people looking at their options for homes right now in the midst of a pandemic. They're spending more time at home. Interest rates are low, if those are the narratives. But what is your outlook for pricing? I mean, whether it's for this month or the months ahead, what do you think we're going to see play out in markets like, the Toronto area?
It's a great question. I wish I knew the answer. Everyone who's trying to forecast prices, obviously it's very difficult, obviously, given all the uncertainty. I would say that the federal government's plan to extend the wage subsidy to the end of the year really supports the housing market, in the sense that a lot of the people who are probably benefiting from that are homeowners, so they're going to probably keep their jobs. So at least in the GTA, I really don't see any significant downward pressure in prices. The sales are up 20+% now in the first half of July. Prices are up double digits. To see a really drastic reversal in the second half of the year, you need some really, really big sort of demand shocks to pull buyers out of the market, and we're not seeing that yet. And some supply side shocks. And we might see some people sort of get a little bit distressed and needs to sell their home, but I don't see that being sort of in the volumes that are actually going to push prices down. I think the big risk right now is what's going on in the condo market. We're seeing a really big decline in rents, partly driven by the fact that immigration has slowed down. So I'd say if there's one segment that we need to keep an eye on, it's certainly the condominium prices and the pre-construction condo market.